I'm just quickly going to run you through this cash flow. It compares buying a principal place of residence versus rent investing. So we've got three different scenarios. The first here is buying a PPOR, principal place of residence, or also known as a PPR. We also have in column number 2, which is turning your primary place of residence into an investment property and then renting either next door or in the same suburb. So there's no difference in lifestyle, but it will just compare the first column where you live in it to if you're renting and you turn it into an investment property, the difference in cash flow. The third scenario is renting and buying an investment property where you're getting the best returns, which is in Brisbane at the present moment. So the first section, we've got the loan to value ratio. We're assuming across all that it's 80% and that the purchase property is just over 900,000. So it's dropped a little bit in Melbourne in the last few months, but it's roughly sitting around 8.5 at the moment. So it's not far off normal Melbourne prices in the market. Then we've also got the rental income in the next section. So obviously if you're living there, there is no rental income. In the second column where you're renting out your property but living next door, there is, this is in Melbourne. So as you can see, the rental yield is somewhere typically between 2.8 and 3.2%. It's actually dropped a bit since the big boom of property numbers going up in Melbourne. And Brisbane, you can see, is a much higher rental return. So that's one of the main reasons we're investing in Brisbane. Brisbane also is set for a lot of growth over the next 3 to 5 years. So we're looking to pick up quite a bit of capital growth in that. So the rental income, because of that difference in percentages, is quite different from Melbourne to Brisbane. The next section we've got is interest on the home loan. So we figured in about 4.5% interest. There is also, we've put in a line here in all of our cash flows. We always are quite conservative, so we account for 100% of the interest. So that means that when your property grows in capital growth, you can take that capital growth out and move it across into a deposit for the next property, and the interest for that has already been accounted for. So that's just accounted for here. So the total expenses for your home loan is the same across all three. The differences are really going to be coming on the bottom end of this cash flow. So the body corporates, all of your expenses are pretty much the same. The only difference is in this line where you're living in it, you obviously don't have a property management fee. And in Brisbane, the property management fee is slightly higher than in Melbourne, but the some of the other body corporate rates and things are typically cheaper than what they are in Melbourne. But for this example, we've left them the same. Next, we have tax deductions and depreciation. So if you're living in your property, unfortunately, the government doesn't see any value in giving you any deductions because they're encouraging investors so that they don't have to supply the housing. For all of our lovely migrants we have coming. So in this second column, you can see that there is some depreciation, and the estimated tax refund is also there as well. Then we've got the post-tax cash flow. So we're looking at this one. Obviously, the first column, there is, that's what you're paying for your mortgage because you're living there. The difference in what you're paying is obviously quite drastic because with these two, you've got your rental income. And as you can see, the side to the right, which is the Brisbane versus the Melbourne market, is you're making a lot better money in the Brisbane market than the Melbourne. Rental expenses. So the first column, again, because you're living in it, there's no rent expenses. or rent that's paid on the property. In the second and third column, you've got your rental income and your overall cash flow. So your overall cash flow, your first property, which is the one you're living in, is costing you almost $50K a year to live in. Then you've got your property where you're living next door, so there's no difference in lifestyle, but the one that you own, you're choosing to rent out, and you're renting the one next door. So you can see down the bottom where the difference is in cash flow, that you're positive almost $9,000 a month, which is about $171 per week. Now, if you're choosing to invest in Brisbane, where you're getting higher rental returns and higher capital growth, then you're looking at almost a $10,000 difference in what you're making per annum. So you're looking at nearly $20K in that situation, or $363 a week. So this is just one of the reasons that we encourage people to purchase investment properties before going and buying your PPR. Obviously, if you've already bought a primary place of residence, we would encourage you. Some people, it depends on your serviceability and also depends on, your lifestyle and what your goals are. I would encourage you to reach out and get a one-on-one to see what your situation is. But one thing I also wanted to talk about and cover is a huge lesson that I learned a few years ago, which is talking about access to things versus buying things. I'll give a couple examples just so that it kind of sinks into home. But there's a good old saying that when you purchase a boat, a boat is a money sinking hole. People say that because boats are expensive to maintain, and let's just say, it's your 40th or 50th birthday, or maybe your 20th, and you want to go rent a luxury yacht. Like, you can go rent one of those for the whole day for probably $10K. You can invite all your friends, you can have a huge party, and it's only going to cost you $10,000, but to moor the boat, to maintain the boat, to do the licensing, to do your own driver's licensing of boats, the list kind of goes on of all the maintenance things that it would cost you to own that boat a year. Another example of that would be, for instance, a holiday house. So if you purchase a holiday house, it's probably sitting there vacant most of the time, which means that that asset isn't actually making you money. So what our goal is to help people build wealth as soon as they can, so then they've got other time to do other things, whether, it's going on holidays or spending time with your family or following your hobbies or giving back or whatever it is for you. But what we really encourage people to do is to tick that financial box where you're not worrying about money or having to go to work if you don't want to, and spending time where it's most important to you. So I hope this has been helpful. If you have any questions, feel free to reach out and let's have a chat.